Something we've all got to think about in the next few months.
And then how does the market trade on a contested election? Has the market have investors even decided to think about that? You know, you talk to these market participants and they say, well, the market can only focus on the thing that's ahead of them, the next catalyst to drop. Has anyone even thought what that would look like to this market?
Yeah, not good. We're up a third of 1% this morning, but I imagine that's not where we'd be off the back of that story. Up a third of 1% on the S&P 500. With an update on stories elsewhere this morning, here's your Bloomberg brief with Yahara Hackers. Hey, Yahara.
Hi, John. Hurricane Milton is approaching the Florida Peninsula with wind speeds up to 155 miles per hour. It's expected to make landfall tomorrow night with intense winds capable of collapsing homes and triggering power outages that could last anywhere from weeks to months. The storm coming less than 2 weeks after the southeast was hit by Hurricane Helene. Meanwhile, the Wall Street Journal says Honeywell is expected to unveil plans to spin off its advanced materials division. The new business could be worth more than $10 billion as a separate public company, according to sources cited in the report. Honeywell hopes the separation will give it more financial flexibility to pursue deals and other opportunities. Meanwhile, PepsiCo shares are falling in the pre-market after the company trimmed its revenue outlook for the year as demand for its drinks and chips fell. The maker of Lay's and Lipton teas is struggling as consumers rein in spending and trade down to cheaper store brands. And they see that pressure continuing, saying in a statement that consumers will remain value conscious. Despite that, PepsiCo is still expecting earnings to grow by at least 8% this year. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on the program, the Morning Calls Plus, Pierre Anderand of Anderand Capital Management as Brent snaps a 5-day rally on the back of a disappointing China stimulus push. That conversation just around the corner.
Could face bigger challenges next.
It was going to keep bringing the World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
David Weston, join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
above all else is a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Equity futures on the S&P 500 firmer here by 0.4%. The opening bell 1 hour and 15 minutes away. A conversation about crude coming up. We're down by 2% on WTI, 75.51. Time now for some morning calls. First up, Wolfe Research upgrading Wells Fargo to outperform, expecting upside from the bank's asset cap liftoff. We're up by 1.5% there. Next up, Oppenheimer downgrading Microsoft to perform, citing overly optimistic revenue expectations due to OpenAI losses. We're positive there, or rather negative by 0.25%. And finally, RBC Capital raising its price target on Tesla up to T36, expecting shares to benefit from the company's robo-taxi event on Thursday. Plenty of coverage on that story later on in the week on this show. We're up by 1% in the pre-market. Turning to commodities, Brent falling below $80 a barrel as China holds back more economic stimulus measures. Metals, including copper and iron ore, slumping, wiping out most of their gains since Beijing's initial policy measures announcement just last month. Joining us around a table, Pierre Underrand of Underrand Capital Management. Pierre, good morning. It's good to see you.
Good morning. Good to see you.
Let's start with this oil market because it's confusing a lot of people. We've had some people come on this show and say there's a threat of dropping to, say, the 50s, maybe even the 40s. Others saying triple-digit crude just on the horizon. How are you thinking about this, and are you positioning bullishly for this story?
So basically, I think there's no medium-term structural trade for crude. I think the market is quite balanced, where we have still relatively large non-OPEC supply growth coming for the next 2 years, and demand growth slowing down. So it gives a bit of a bearish bias to crude, but against that, we have the largest short ever in terms of spec positioning in the market. And non-OPEC supply growth has disappointed relative to expectations. So we're expecting 1.1 million barrels a day of non-OPEC ex-US supply growth this year. We're getting at 400,000 barrels a day. Next year it's expected to be 1.5 million barrels a day. It could well be 1 million barrels a day lower. So I would say overall, the market doesn't need more OPEC oil for now. And so when they speak about bringing oil back over the next few months, it puts some pressure on the market. But against that, we have geopolitical risk. With clearly, we are waiting for Israel's response to the Iranian attacks and generally the axis of resistance attacks on Israel. So that could impact the oil market quite significantly.
What's your base case, your overall conclusion? Would you say the risk is for higher prices and not lower ones, at least in the short term?
I think in the short term, the risk is for higher prices, yes, because inventories are low. The market has been trading on next year's balances, but it's hard to get much confidence on those. And speculation is at all-time low, and we have lots of supply risk potentially in Iran.
Pierre, how high? Because in 2023, you had a call of $140 per barrel in oil. Yeah. What could this geopolitical risk push it up to?
So it really depends. So let's say if Israel blows up the oil export facilities of Iran, so basically we would lose 1.7 million barrels a day, which out of a 100 million barrels a day market is important, but not too much of a game changer. Saudis and UAE and Kuwait and a few OPEC countries could increase production to make up for it over time, but it would actually tighten the market and bring prices up. Then the question is, how would Iran react to that? Would they, they said that they would blow up oil facilities in the region, in Saudi Arabia and UAE and all that. So would they do it or not? I mean,
But is there a range? Are we talking about $80 where we are now? Or we're talking about 100 or 120?
I don't think. I think maybe like $10 to $15 higher. So I'm not calling for much higher oil prices, but I think they're more biased to the upside. I mean, the average price last year and this year for Brent has been around $80 a barrel. That's like we are just under that now, so it would make sense to be a bit higher at least than the average.
You mentioned OPEC. Do they need to keep the cuts in place throughout 2025?
That will depend. I think they will only bring oil back if it's needed. I don't think they will push it on the market. Saudis might threaten to do so in order to keep a few members in compliance. But I don't believe that they will go for a market share story and bring a lot of unneeded oil back. So I think that's why I don't call for much lower oil prices or much higher. But I think in the short term we could go $10 to $15 higher.
We've talked a lot about supply. When it comes to demand, you have still a strong American labor market. You have Chinese stimulus. How do you understand the evolving picture of demand?
So basically, you have to look first in the long term. So from 1986 to 2019, demand was growing pretty much in a linear fashion, growing by 1.2 million barrels a day per year. And then obviously after COVID, we lost a lot of demand. It recovered most of it since. And due to EVs and biofuels, that demand growth should slow down, probably be around 800,000 barrels a day over the next few years. Eventually, demand should reach a peak within the next 5 years, and I think be relatively stable and then start declining slowly. So demand shouldn't really push prices, up too much. But then it's always going to be, like the equation is the growth of supply versus the growth of demand, and demand is still okay for now. There's no issues with demand, but it's not going to grow very strongly, but it's still growing.
We were talking about sort of the long-term, 5-year picture of what EVs does. In the very short term, it's a market that is upset that it didn't get more stimulus from China today. The already existing stimulus that's in there, assuming that's where we stand and that there's no more added, how much does that add to the physical demand? How does that actually show up?
So basically, this year, we grew by around 800,000 barrels a day demand relative to 1 million barrels a day expectations. It's really China that came much below expectations. So the stimulus and the economy doing better in China should bring us back towards expectation or slightly higher. But it's hard to put a number on it until we see all the details. So it sounds like we'll have more details probably just after the US election results in early November, where the NPC is supposed to speak about really the fiscal stimulus. And the market was expecting 2 to 3 trillion RMB of stimulus. Today, the NDRC didn't speak about it because the NPC is supposed to be the entity speaking about it. So we might know more in a month's time, but the market is a bit impatient and selling off on the lack of news.
So equities in Hong Kong got absolutely hammered. Copper's pulling back a little bit over in London on the LME. We're 10% off the highs of the year on copper. We got to those highs back in May of this year. Are you still long?
Yeah, I'm still long copper because the long-term story for copper, the structural story is very clear, where we have mining supply is supposed to peak within the next 2 years. Against that, we get an acceleration of demand growth due to the electrification of the world. And inventories are still low. So, we get a lot of bearish news on China in terms of construction, but construction only, like copper demand, construction represents only 20% of the, it's still large, but it's 20% of copper demand in China. It's not 80%. So there's a lot of other, parts of the copper demand that is growing really strongly in China.
We got close to 11K on copper earlier this year. Felt like a big number. What kind of numbers do you think we have to get used to in the copper market, given the multi-year trade that you're thinking about?
Yeah, I think it's, demand should over time not be, very price sensitive. So sometimes it's price sensitive in the short term where you get a deferral of demand like we saw in China in Q2. But it's not like the total level of demand, over the year is going to change. It's just a deferral of demand. So I think, copper is a small market. It doesn't represent, so many dollars, in terms of the global economy. So it shouldn't be, and it's needed. You need copper to actually electrify the world. You can't really do without. And the fact that it takes, at least 7 years to bring new mines means that, like in the short term, there's no real, you can't really do much about the supply. You get some short-term fixes, are getting more scrap, but that's only for a few months. So basically, I think the demand should be relatively inelastic, which means that in order to get the demand response, you need to have basically much lower demand growth than what we need. We need much higher prices. So for me, I think it's copper prices could go up by a few multiple, by 2, 3, 4 times over a few years. So from 10,000 to 30 or 40,000. Not this year, right? But over a 4-5 year horizon, it could.
Pierre, in June, you exited some of these oil trades. Sounds like you're a little bit more interested in oil now, given the volatility going on. You were bullish on copper. What about cocoa? Because that's something else you were saying that prices were going to move higher.
Sure. So in cocoa, we had a massive deficit this year that represents around 10% of world's demand. So it's as if we had a shortfall of 10 million barrels a day of crude oil, and believing that things will get better. But clearly, like cocoa is a different market from crude. Every year you get like new production. But basically, we had inventories, are at very low levels. It's similar to the late 70s. If you look at inventories to demand ratio, we're back to the late 70s kind of levels when cocoa was between $15,000 to $28,000 a ton in terms of today's dollars.
Yeah.
And next year, so it all depends if next year we're going to have a deficit or not, and we'll know more over the next few months. But
it's up this morning by about 2.5%. Pierre, it's good to see you. Appreciate it.
Good to see you.
So the world tour of commodities with Pierre Underrand of Underrand Capital Management. Up next, we'll catch up with Tom Porcelli of PGIM.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
60 minutes away from the opening bell, equity futures on the S&P 500 with a bounce, a little bit of a lift. We're up by 0.4% on the Nasdaq 100. Danny, up by 0.4.
Yeah, I mean, finally, we're getting a little bit of a rebound, but I think it's notable that you had equity markets yesterday unable to continue gains. That finally you're in an environment where higher yields seemingly upset markets.
Those yields stick this morning on a 10-year, up by 2 basis points, 4.04. Danny, at the front end of the curve, we give it up, 3.99 on a 2-year.
It is, again, this kind of idea that maybe on the long end yesterday it was finally attractive again. Yay, 4%, I can go ahead and dive in. This time, maybe not. So, John, quickly, just to go through some of the movers this morning. Honeywell up nearly 2%. It's planning to spin off its advanced materials division, have a separately listed business by early 2026 at the latest. They want to simplify Honeywell's business around 3 main segments: aviation, automation, and the energy transition. Also higher this morning, NVIDIA. Before I get into the individual story, just worth noting that NVIDIA was one of the few Mag 7 to gain yesterday, and congrats NVIDIA, you're now, again, the second largest company, overtaking Microsoft. The individual story this morning, up more than 1.5%. Han Hai is building a new server facility for them in Mexico because they say there is, quote, crazy demand for their Blackwell chips. Finally, just rounding that with Pepsi. John, you and I have already talked about this. PepsiCo cutting their outlook, shares down 0.5%. The consumer, they say, is still value focused. There was an unexpected decline in summer sales. They're cutting costs, trying to keep up profits that way, but it is a cash-strapped consumer. They're dealing with boycotts in the Middle East and a major recall, all of that hitting volumes, John.
Are we going to see another quarter of those kind of headlines? A big emphasis on cost management. Danny, thanks. Let's talk about the week ahead. Turning our focus to this week's economic data, CPI coming on Thursday, followed by PPI on Friday. The inflation data offering clues for the Fed's rate path after the better-than-expected September payrolls report triggered fears of a no-landing scenario, or hopes, depending on how you look at things. Tom Porcelli of PGIM Fixed Income joins us now for more. Tom, good morning to you. It's good to see you.
Good to see you. How's everyone?
How high, how low is that bar to hit pause at the Federal Reserve?
I think that I think today it's relatively high. But in fairness, it's also lower than what it was before that payroll report. Look, I think the Fed is really going to start to try to understand where we are from a neutral perspective, even more so than what they've been doing over recent months. Because we were just saying before we came on, we said, what a week, and then we said, what a year, and then I said, actually, what's been really interesting about this year is that we've gone through like sort of almost a series of mini cycles.
What a year in a week.
Within the year, yeah, exactly. And I think when I think about the data that we've been looking at, I mean, look, we've been in the soft landing camp for a while. Although I'll hasten to add, I actually hate the term soft landing. I think I literally said on this show. The problem with soft landing is it sort of would suggest that things have stopped, right? If you landed, you've stopped. But if you want to keep it in aeronautical terms, I think we could talk about altitudes. And we thought that you would be operating in sort of an altitude of 1.5% to 2%. But I think if that report was to be believed, then you're in the upper end of that range. And I think that, to me, is really where the conversation is going.
You said if that report is to be believed. just sort of tease that out a little bit more. What do you mean by that?
So I lobbed it out there like a big fat meatball for you. So I think what happened on Friday was pretty impressive. The report itself was pretty impressive. But it doesn't expunge all of the other data that we've been getting over the course, by the way, not even over the course of the last several months, just over the course of the last couple of weeks. I mean, we know that the quit rate is down. We know that the labor differential is down. I mean, there's a host of other labor data that I think you can't just erase. And again, look, we've been thinking that, again, things would sort of hang in there just fine. But I'm not ready to sort of say, hey, everything's okay now. The unemployment rate is still up 600 basis points. So I think, there's still a long way to go. I mean, the chapter is not over, right? I mean, I think it's still ongoing, and I think that's an important idea.
The irony, though, is it's a world awash in data, and you'd think that'd make the picture clearer, and for some reason, it's making it more
complicated. Makes it even muddier. Yeah, I totally agree. Look, I think, and this is the challenge. I mean, we can have a whole hour-long session on this. I think post-COVID, I think that the seasonal adjustment process for some of these data points are probably a little quirky right now, and I think that's just something we have to sort of live with. I think about leisure and hospitality is sort of a great example. Leisure and hospitality jobs. You would normally see a massive decline in September in NSA terms. And we saw a big decline. It just wasn't as big as normal. So if you don't get as big of a decline as normal, then all of a sudden, in seasonally adjusted terms, it flatters the outcome. And again, that's not making excuses for the data. That's just being informed. I mean, I think we have to understand that there's a lot of quirkiness that seems to be going on, and I think sort of this back and forth on the data is really highlights that.
Well, on the data, we'll get one more jobs report before the Fed meets.
Yep.
And they've avoided one headache when it comes to the union workers.
Yep.
But how on earth are they going to look at the impact of the hurricane, Helene, and now the one that's about to hit Florida?
I hate to say this because we were just talking about this. This would be a sort of a great opportunity to use the word transitory, but that's been sort of struck in from the lexicon at the Fed. But I think you have to look through some of this. I mean, some of these impacts are going to be temporary, which maybe is a better word than transitory. And I think that's going to be the reality. So I think this coming payroll report could be a little bit messy on the back of that. And I think we're going to have to look through that based on some temporary factors.
Let's talk about CPI. On Thursday. I'll share some of the language that John Williams shared with the Financial Times in the last 24 hours, that if inflation fell faster than expected, that would call for policy to normalize a little bit more quickly. If inflation stalled, that would call for interest rates to come down more slowly. I've asked this question a few times this morning. There's a bias to reduce interest rates regardless of what the inflation data looks like on Thursday. What do you take away from that?
Yeah, I think that's fair. I mean, I think that, policy was it's funny. I think one thing that Powell said, which I totally agree with, something we've been saying, is cutting rates now is all about extending the cycle, right? That's all they're trying to do right now, and we have nothing but sympathy for that idea. It's exactly what we think they're supposed to be doing. So I think in the context of policy that was calibrated for meaningfully higher inflation, with inflation now having come down, I think that you can easily take back some of that aggressive tightening that they put in place. So for us, we still think that what this has done is it's removed the urgency to go aggressively. I still think you're going to get into the realm of neutral, but you could probably do that in a little more of a casual way.
And then this gets back to your point, though, of cycles happening seemingly in days. Before that Friday report, we were pricing in 20% odds that they cut by 50.
Yes.
Post-report, 20% odds that they just don't cut at all. What's needed, or when can I even expect a world where you don't have these wild swings in Fed pricing? You don't have bond markets swinging like they're mega cap stocks.
And Danny, think about it too. At the beginning of the year, the market was looking for 6 or 7 or even 8 cuts, and then they scaled that back, and now they were looking for aggressive. I mean, it's been a wild swing, which was to the conversation we were having a moment ago. Look, I get it. We're all at the mercy of this data that have been noisy. And again, it's just consider this. What if next month, payroll report, even excluding any of the hurricane impact and the strike impact, et cetera, you print 50,000. which, by the way, is not out of the realm of possibility when you consider the sort of the standard error on this thing.
Sure.
So I just think we're at the mercy of what's been very volatile data.
You said the Raman neutral. Can we explore that a little bit? What's the Raman neutral?
Yeah, I also said strucken, by the way. I'm just realizing when I should have said stricken. So hopefully you can edit that out or something.
We'll try and edit that later.
I think the realm of neutral is somewhere between 3 and 3.5%. I think that's the right way of thinking about roughly where it is. I think we all appreciate this. It's very hard to know that number in real time, if ever. But I think that's probably where this is a journey to.
So do you think it's fair to say the next 100 basis points of decisions are the easy ones? Is it fair to say?
I think that is very fair to say. And look, I think if all of a sudden, and again, we have to be practical about this. If all of a sudden you're going to start printing 254,000 jobs month after month, then guess what? The easing cycle is coming to an end. Right? I mean, I think that some element of practical has to enter the equation on that.
My worry is that in a few months' time, we revise these numbers in a big way and people start to throw some accusations that they were put a certain way for political reasons, which we all know is not how it works down in Washington, D.C. But that would be my worry come December, looking back a few months.
Well, when those revisions came out for the year, it was down some 800,000, and now basically everyone comes on and says, doesn't matter what the payroll report number is, you take out 60 or 70. And in this report, a lot of people are sending me private messages why I'm not talking about the fact that I think government jobs was about 37,000. They're saying this is basically just to cook the books before the election.
Tom, just a final word on that. Where is the demand coming from? How much breadth is there in the demand for jobs in America?
I love this question, and I think it really gets to some of the nuance of the last report. I mean, you think about leisure and hospitality jobs, adding 80,000. The prior few months, it had been averaging, what, 40,000. So the delta was a massive swing. You think about healthcare, which has just been an engine. But over the prior few months, it was averaging maybe 30 or 40,000 jobs, and all of a sudden it bounced up to also about 70 or 80,000 jobs. So you had these big deltas. I think the biggest source of strength has been healthcare, full stop. I think it'll continue to be sort of a source of strength. But when I think about it sort of outside of that one really key point of strength, it's, you've seen modest gains sort of throughout or over the course of the last few months. But I think key is going to be healthcare. I mean, to me, that's a long-term structural idea based on aging populations and et cetera. And I think that will be an engine for a while.
A big tailwind for hiring. It's good to see you, Tom. Appreciate it, as always. Thank you, sir. Tom Porcelli there of PGIM Fixed Income on the Federal Reserve and the economic data in America. As we count you down to the opening bell, about 50 minutes away. Equity futures shaping up as follows on the S&P 500. A little bit of a bounce. We're up 0.4%. Yesterday's session, the biggest one-day loss in around about a month on the S&P 500. The Nasdaq 100 up by about 0.4%. The Russell up by 1/10. The bond market getting tons of attention over the last few days, particularly at the front end of the curve. The two-year high by almost 40 basis points through last week. Yesterday, we added to some of that move. This morning, we take back just a little bit. We're down a basis point on a two-year at 398.33. On a 10-year, we hold on to 4%. We're up about a basis point or two, 4.04. With us around the table, logged into the Bloomberg terminal, Mark Cabana of Bank of America. Mark, it's good to see you.
Likewise, good to see you.
Thanks for joining us. What's changed from you and your calls for the Federal Reserve based on what happened on Friday?
Sure. We were in the 50 basis point cut camp for November. The data dictates that is no longer necessary. So we now think that they'll go 25 and that they'll deliver a string of 25 basis point rate cuts until they get to March of next year, so around 4%. And then they'll slow down to a quarterly pace of cuts until they get to a trough of 3 to 3.25. At least that's the base case. Now, I'll tell you that amongst our clients, there's a lot of uncertainty out there right now. The data has surprised. It doesn't seem like the data is giving us a particularly clear narrative on what's going to happen. And we sense that investors are really shifting probabilities of what the most likely economic outcome is. There was a lot of belief that we were headed to a soft landing with elevated risks of a recession, or at least increasing risks of a recession. Now, soft landing is still the base case, it seems, but the market is putting a little bit more weight on the possibility that maybe there's a quote-unquote no landing type scenario, or maybe the Fed doesn't need to cut much below 4% at all. And so the market right now, we think, given that uncertainty, is just trying to be a bit defensive. Rates clients don't want to extend too far out the curve right now, especially given that we're just about a month away from the election. And as a result of that, they're keeping things nimble and light and kind of waiting for data to try and guide a bit more.
We saw money pile into money market funds as well ahead of that economic data. And I've asked this a few times. What do you think is behind that move? What's driving that?
Rates are still high. And just because the Fed is cutting doesn't necessarily change your behavior as a depositor. Ask yourself, what does your retail bank deposit pay you? If it pays you something close to T-bill yield, you should tell me where you bank, because I'd be interested in knowing that. But for most retail depositors, they're offered something close to zero. And so T-bill rates are still well above that. And so we do think that there's going to continue to be a lot of inflows into money market mutual funds, even if the Fed is cutting. Because it's not about whether rates are rising or falling, it's about the overall level of interest rates. And work that we have done says the overall level of interest rates. And work that we have done says that you shouldn't expect to see really large outflows from money funds unless the Fed cuts to something that is at or below 2%. And that seems very unlikely based upon the data that we have at hand and what the market is thinking about the Fed cutting cycle.
Mark, it's also a 10-year that's been going higher. Yields have been going higher, even since before the Fed cut by 50 basis points, and it's just continued on. How much of that is just a factor of what you first started talking about, that unknowingness, that vulnerability, and that volatility just adding a premium to this bond market?
Well, I think it's a couple of things. Number one, I think it's that rates investors do believe that a more proactive Fed today means a better economy tomorrow. And think about on the day when we saw the Fed cut 50, you actually saw long end yields rise because there was a sense that the Fed was going to be decisive, act quickly, do what it takes to support the economy, and then that should allow for better growth in the future. That, we think, is arguably the biggest part of why the back end has been moving up a bit. But there's also supply-demand concerns, and the election is a big wild card. Certainly, it doesn't seem like fiscal policy is going to be tightened in a big way after the election. And so we can debate, well, how easy will fiscal policy get based upon the election outcome? But I think investors are just a little bit reluctant to extend out the curve, knowing that you can get political outcomes that would result in much easier fiscal policy and more Treasury supply.
As you're saying this, though, I'm thinking in my head, who is the candidate for less fiscal spending?
So I don't want to get into the politics too much, but
it's a good response.
Thanks. Yeah, I've been trained well by B of A media people. Investors right now do not expect that there's really any party or any candidate that supports meaningful fiscal austerity. And so therefore, it's just a question of whether or not the fiscal outlook gets a lot worse or a little worse. And investors, knowing that the election is very tight and knowing that investors don't want to take a strong call on that right now, are deciding to just stay a little bit shorter duration. So some of the flows work that members of my team do sees that there are very sizable inflows into fixed income funds, not too different from the money market mutual fund inflows, John, that you referred to earlier. But when those flows come in, they're generally staying short on the curve. And that is due to investors who just don't have a lot of confidence in what the political or macro backdrop looks like in a month or so. And as a result of that, these positions are kind of de facto in steepeners. And when you get really strong data, like we had on Friday, then that does create a bit of a tension for investors who have moved further in on the curve.
Jonathan and I were just talking about the fact that if we might not have a decision days or even weeks out. This could also drag on for months. This could be contested. What do flows on the short end look like then?
So it's a great question. I guess I would just respond by saying that over recent weeks and months, we have certainly seen that treasuries have regained their flight to quality attributes. When inflation was high, let's say rewind a year ago or so, I think we could have debated how much treasuries actually retained that flight to quality benefit. But if there is acute uncertainty, whether it's due to U.S. politics or whether it's due to geopolitics, we do think that treasuries will still retain that flight to quality attribute. And we should expect to see cash move into treasury securities, probably mostly at the front or belly of the curve in those types of scenarios. But certainly for the asset class overall, we do think that it will retain those kind of risk-off or flight to quality benefits that we have historically seen.
We've talked a lot about the front end. You've talked about how that money and money market funds could be quite sticky unless Fed funds comes down to something like 2. Can we talk about the long end and just finish there?
Sure.
What are you looking for at the long end of the curve? What kind of numbers? We had a guest from PGIM yesterday saying we're in the buy zone, 4% to 425, lock it in. Get a second buy, a second opportunity, take it. What's your advice?
Yeah, so we wrote yesterday that we do think, at least using the 10-year as a proxy, between 4 to 4.25 is a reasonable place to begin scaling in. We're already there, obviously. But here's the framework that we have used. And a number of folks on our team have recently written about this in slightly different ways. But we call it a 2-3-4 type framework. The Fed is almost certainly going to cut to 4%, almost regardless of the data. Don't believe me, look at their dots. In 2025, all dots except one are below 4%. So that seems to be the recalibration zone, and that's maybe consistent with quote-unquote no landing. And so if the economy performs really well, then 4% is probably where they'll end up. In a soft landing scenario, using the Fed's own baseline, they'll probably end up closer to 3%. That's the B of A House view, that's our economists' view as well. And if there's a recession or some type of sharp slowdown, then you can envision a 2% or lower type of outcome. So then the question is, we assign probabilities to those various outcomes. And again, our base case is the soft landing. That's all well and good. But if you just look at 10-year OIS, let's say, and that's around 360 at